I kept hitting refresh this morning. I was sitting here, coffee was cold, just staring at the terminal feed from the CME group, and I honestly thought the data was lagging or broken because the number on the screen, 28 million, it doesn't fit the physics of the market I've traded for 20 years. It's just gone. If you look at the registered silver inventory, that's the metal that actually exists, the stuff that's supposed to back every single paper contract, every ETF share, every digital promise people are holding in their retirement accounts right now, it just breached a level that isn't supposed to be breachable, 28 million ounces. To put that in perspective, that's not a stockpile, that's a rounding error. In a market this size, with the amount of industrial demand we have from the tech sector, that is effectively zero. We are running on fumes. But here's the thing that's actually keeping me up. It's not the number itself, it's the reaction. Silence. The price isn't moving. The volatility index is asleep. If you turn on the financial news, they're talking about interest rates or, AI stocks. They aren't talking about the fact that the London vaults just signaled a critical failure in delivery. They aren't talking about the lease rates, which are quietly screaming that there is no metal left to borrow. It feels exactly like 2008 in the mortgage market. Everyone knew the math was broken, but nobody wanted to be the first one to say it out loud because if you say it, the game stops. We just crossed a red line, not a technical support line, a physical red line. The math says a squeeze isn't just likely anymore. It's guaranteed. It's baked into the cake. The only variable left is when the paper market admits it. And I found something else this morning, a small detail in the settlement data that usually nobody looks at. It suggests that when isn't months away. It might be, let me show you what I found. Because once you see this ratio, you can't unsee it.
See, the number that usually gets thrown around is the total stockpile. You'll hear people, usually the guy selling you coins on late night TV, saying there's hundreds of millions of ounces sitting in the vaults. And on paper, they're right. If you look at the headline number for COMEX inventory, it looks manageable. Not great, but manageable. But that's the trap. That's where the detail I found this morning matters. Because there are two piles of silver in those vaults. There's eligible and there's registered. And nobody explains the difference because if they did, the panic would have started 6 months ago. Eligible silver just means it's sitting there. It meets the purity standards, sure. It's the right weight, but, and this is the part that keeps getting glossed over, it is not available for delivery. It's owned by someone. It's spoken for. Maybe it's a family office in Zurich. Maybe it's a tech manufacturer in Taiwan who needs it for next year's chips. It doesn't matter who owns it. The point is, it's not for sale. It's just parking. Registered silver is the only pile that matters. That's the pile that backs the futures contracts. That's the pile that has a warrant attached to it, meaning it's ready to move. That's the liquidity. And that is the pile that just hit 28 million ounces. I want you to really visualize that for a second. 28 million ounces. At roughly $20-some an ounce, we're talking about a global inventory value that is less than the market cap of a mid-tier tech startup. The entire physical backing of the world's most critical industrial metal, the thing that makes your phone work, your solar panels work, the thing that's in the missiles we're shipping overseas, is worth less than a bad day of trading for NVIDIA. It's absurd. It's actually offensive to the math. And this is where the contradiction hits you. Because if you look at the price action on the chart right now, I'm looking at the hourly candles, it's flat. Actually, it's down a few cents. How is that possible? If the warehouse is empty, why is the store owner lowering the price? Because the market isn't trading silver. It's trading paper promises of silver. I was reading a report from the classic smart money crowd, won't name the bank, but you know who they are, and they're still talking about surplus. They're counting that eligible pile. They're saying, oh, don't worry, if the price goes up, the owners of that eligible silver will sell it into the market and stabilize everything. Will they? I'm not so sure. Actually, I'm looking at the withdrawal data from the last quarter, and I'm seeing the exact opposite. The people who own that metal aren't selling it. They're taking it out of the vault. They're taking delivery. They aren't waiting for a higher price. They are worried about counterparty risk. They don't want a receipt from a vault in New York. They want the metal in a private depository in Texas or Singapore. That flow from in the system to out of the system is the real story, and the velocity of that flow is accelerating.
Here's the hard data point that nobody is talking about. In the last 48 hours, since that 28 million breach, the ratio of open interest to registered silver just blew out to something like 300 to 1. Think about that. For every 1 ounce of physical silver sitting in that registered pile, there are 300 paper claims floating around in the futures market. 300 people think they own the same ounce of silver. Now, in normal times, this is fine. It's a confidence game. It works because nobody actually asks for the metal. Most traders are just speculators. They want to bet on the price, make their cash, and go home. They don't want a truck showing up at their house with 5,000 ounces of bullion. So the banks can play this fractional reserve game forever. They can sell the same ounce 300 times because they know only one guy will ever ask for delivery. But what happens when 2 guys ask? Or 5? Or 10? That's the red line. That's the squeeze. It's not about everyone asking for delivery. It's about just enough people losing faith in the paper contract that the buffer, that 28 million ounces, disappears. And once it hits zero, the game is over. The curtain falls. The 300 guys holding paper realize they're holding paper. This next part is where it stops making sense if you listen to the mainstream narrative. You'd think logically that the industrial buyers, the guys who actually need the silver to build things, would be the first to panic. But they aren't, not publicly. I've been tracking the procurement orders for some of the major solar manufacturers, and they've been quiet. Too quiet. My theory is they aren't buying on the COMEX anymore. They know the COMEX is a hollow shell. They're going direct. They're doing off-market deals with miners. They're securing supply at premiums that aren't showing up on your ticker. That's why the spot price looks calm. The real price, the price to actually get your hands on a 1,000-ounce bar right now, is detaching. I called a dealer friend of mine in Chicago yesterday. I asked him what the premium is on a generic 1,000-ounce bar. He laughed. He said, if you can find one. See, the spot price is the price of a contract that might not be honored. The physical price is the price of reality, and reality is getting expensive. But there's a group of people who are misreading this completely, and unfortunately, it's the retail crowd, maybe even some of you watching this. I see comments all the time saying, I bought SLV, I'm ready for the squeeze. Listen to me very carefully. If you own an ETF like SLV, or if you have unallocated silver in a bank account, you are not protected. You are the buffer. You are the liquidity that the big players will use to try and save themselves. When the authorized participants need metal to settle a physical delivery for a big industrial client, where do you think they get it? They redeem baskets from the ETFs. They drain the metal out of the fund to satisfy the physical demand, and you're left holding a share price that tracks a futures market that is effectively defaulting. You are standing on the train tracks thinking you're driving the train.
This is why I don't trust the stability narrative. The official sources, the LBMA in London, the CME in Chicago, they have to project stability. Their entire business model depends on confidence. They cannot come out and say, hey guys, we're running a bit low, maybe don't ask for your silver this month. That would trigger the bank run immediately. So they use leasing. This is a mechanism that's a bit technical, but stay with me because it's the smoking gun. When a bank is short on silver, when they sold more than they have, they can lease silver from another bank or a central bank. They pay a fee, they get the metal on their books for a while, and it looks like they're solvent. It's like renting a suit to look rich for a job interview. Well, the lease rates just spiked. I saw data from London this morning. Lease rates for 1 month silver jumped. That means banks are desperate to borrow silver right now. Not next month, right now. Why would you pay a premium to borrow an asset that supposedly has a surplus? You wouldn't. You only do that if you are facing a delivery obligation you can't meet and the cupboard is bare. It's the financial equivalent of checking under the sofa cushions for loose change while the landlord is knocking on the door. And yet, the price sits there. $20-something. It feels like the water receding before a tsunami. You know how that works? The ocean pulls back. It looks weird. The beach gets huge. People walk out to look at the seashells and the flopping fish. They think it's a curiosity. Look, the water is gone. No. The water is stacking up. It's gathering energy. The friction between price and reality is building up a level of potential energy that this market hasn't seen since, well, maybe ever. Because in 1980, when the hunt squeezed the market, we didn't have this level of industrial dependence. We didn't have solar panels. We didn't have electronics and everything. Silver was just money and jewelry. Now it's a strategic resource.
We are running out of a strategic resource, and the market is pricing it like it's dirt. In a minute, I want to talk about the mechanism that actually breaks this, because it's not just buying more silver. There is a specific structural failure point in the clearinghouses that I think is going to trigger this. It's boring, it's legalistic, and it's going to catch everyone off guard. But before we get there, you have to understand one thing about that 28 million number. It's not static, it's moving. And based on the daily withdrawal reports I'm seeing, it's not moving in the right direction. We are burning through about 1 million ounces a week in net outflows. Do the math. If we have 28 million left and we burn 1 million a week, that gives us roughly 6 months. But markets don't wait for zero. They panic before zero. They panic when they realize zero is inevitable. And I think we just crossed the line where the smart money realized exactly that. The panic hasn't hit the price yet, but it's hit the vaults. And usually the price is the last thing to know. This brings us to the mechanism that everyone is getting wrong. When people talk about a squeeze, they imagine a movie scene. They picture guys in suits shouting on a trading floor, the price ticker going vertical, green candles smashing through $50, $100. They think it's going to look like GameStop. It won't. Not at first. See, the silver market isn't a stock. It's a supply chain. And supply chains don't explode, they seize up. The mechanism I'm watching, the thing that keeps me up at night, isn't the price. It's the delivery manifest. It's a boring, bureaucratic document that tells you who got their metal and who got a deferral. A deferral is the polite way of saying, we don't have it right now, but we'll pay you a little extra to wait until next month. And right now, those deferrals are starting to happen in London. That's the signal most people are ignoring because it doesn't show up on a price chart. You have to dig into the LBMA clearing stats to find it, but it's there.
Why does this matter? Because the COMEX, the U.S. market, relies on London for liquidity. If London sneezes, New York catches a cold. If London freezes, well, New York defaults. And this is where the force majeure comes back in. I mentioned it earlier, but let's actually look at what it means. In the fine print of these futures contracts, there is a clause that allows the exchange to settle in cash if physical delivery becomes impossible due to circumstances beyond their control. Think about that. You bought a contract because you wanted silver to protect against inflation. The market squeezes, the price of real silver goes to the moon because nobody can find any. But the exchange declares force majeure. They don't give you the metal, they give you a check. They give you the paper price of the metal at the moment they declared the emergency. So you get your dollars back, but the dollars are worthless because inflation is spiking and you can't buy any silver with them because the physical price is now double the paper price. That is the trap. That is the mechanism. The squeeze isn't a victory lap for silver bugs. It's a rug pull. It's the moment the paper market admits it's a simulation and disconnects from reality. And the people trading the paper, the algos, the day traders, they don't see this risk because their charts don't show counterparty risk. They just show price. Now, I want to pause for a second because I've been doing this a long time, and I know how easy it is to get tunnel vision. I know how easy it is to look at a chart like that 28 million ounce drawdown and see only what confirms your bias. So let's be honest. What would invalidate this entire thesis? If I'm wrong, how am I wrong? Well, the biggest risk to this squeeze narrative is a massive, sudden deflationary crash. A global recession. I'm talking about demand destruction. If we go into a severe depression tomorrow, industrial production stops. Solar panel factories shut down. Electronics manufacturing halts. If that happens, the 50% of silver demand that comes from industry, it vanishes. Suddenly, that 28 million ounces doesn't look so small. Suddenly, the tightness evaporates because nobody needs the metal to build anything. Or maybe there's a hidden stockpile we don't know about. Maybe the Chinese government or some sovereign wealth fund decides to dump 50 million ounces onto the market to suppress the price. It's possible. Opaque markets are opaque for a reason. If we see lease rates drop back down to zero, if we see inventory start flowing into the COMEX instead of out, then I'm wrong. Then the squeeze is off, and I'll be the first to say it. But that's not what I'm seeing today. What I'm seeing is the opposite. I'm seeing industrial demand accelerating because of the AI build-out. All those chips, all those servers, they need silver. And I'm seeing mine supply stagnating because it takes 10 years to open a new mine and nobody invested in CapEx for the last decade. So we have rising demand, falling supply, and a paper market that is levered 300 to 1. Which brings us to the binary setup, the fork in the road. We are approaching a point where the market has to make a choice. It can't stay here. It can't stay at 28 million ounces forever. Path 1, the soft default. The exchange changes the rules. They raise margin requirements to 100%. They force everyone to liquidate their positions for cash. The price of paper silver crashes or gets capped, but you can't buy physical metal anywhere for less than double the spot price. The market splits in two, a fake paper price and a real street price. Path 2, the hard squeeze. The dam breaks. Someone big, maybe a tech company, maybe a country, stands for delivery of 5 million ounces, and the vault says no. The news leaks, panic hits, the price goes vertical, limit up, day after day, until it finds the level where people are actually willing to sell their physical jewelry and silverware. And frankly, looking at the leverage, I don't see a path 3. I don't see a soft landing where everyone just shakes hands and goes home. The math is too broken for that. The question isn't whether it breaks, it's how they try to fix it when it does.
And that fix, that's what I want to talk about in the last part. Because if you're holding paper thinking you're safe, or if you're holding physical thinking you're going to be rich overnight, you need to understand the end game. Because the rules are going to change the moment the panic starts. Part 3. You see, history has a very specific way of rhyming when it comes to broken markets. And the rhyme isn't usually everyone gets rich. The rhyme is the exchange protects itself. I keep thinking about the nickel market a few years back. Do you remember that? The price went vertical. It doubled in hours. It was the squeeze of the century. And what did the London Metal Exchange do? Did they congratulate the longs? Did they pay out? No. They halted trading. They canceled billions of dollars in retroactive trades. They literally rewrote history to save the banks that were short. That is the precedent. That is the playbook. So, if you are sitting there with a leveraged long position on COMEX silver, waiting for the price to hit 50 or 100 so you can cash out, you are betting against the casino in a game where the casino owns the light switch. If the squeeze happens the way the math says it should, they won't let the price discover its true level on the screen. They will halt it. They will force settlement at a fixed price, maybe 30 or 35, and they will clear the board. And you'll be sitting there with cash in your account feeling like you won until you try to buy actual metal with that cash. Because while the screen is frozen, the street price, the price to actually get metal in your hand from a dealer or a refinery, that price isn't going to be 35. It's going to be 60 or 80 or sold out. This is the bifurcation I'm preparing for. A world where we have two prices for silver. The official price, which is managed, suppressed, and essentially fictional, and the real price, which is whatever someone is willing to pay to get the metal they need to finish a solar project or hedge their currency risk.
So if that's the scenario tree, if we are looking at a potential freeze of the paper market, what do you actually do? Well, I'll tell you what I'm watching, and more importantly, what I'm not doing.
I am not buying options. I am not buying futures. I am not touching anything that has counterparty risk written in the fine print, because in a force majeure event, those contracts are the first things to get torchlit. I want assets that don't rely on someone else's promise to perform. I'm watching the exchange for physical, the EFP market. This is where big institutional players swap their futures contracts for actual metal in London. Usually it's a boring, low-volume window. Lately, it's been chaotic. The premiums to swap paper for metal are widening. That is the smart money heading for the exit. They are quietly converting their bets into bars before the door shuts. If that EFP premium blows out, if it suddenly costs $1 or $2 over spot just to swap the contract, that's the 2-minute warning. That's the signal that the insiders know the default is coming. And this leads to the hardest part of the trade, patience. If the squeeze starts and the price spikes and then the exchange slams the brakes, the psychological pressure to sell will be immense. You'll see the price drop. You'll see the headlines saying silver crisis averted. You'll see the margin clerks calling. But if you hold physical, none of that matters. The volatility of the paper price is irrelevant to the utility of the metal. I'm looking at the industrial side of this. The solar manufacturers, the EV makers, they can't trade paper. They can't build a solar panel with a futures contract. They need the atoms. And right now, they are starting to panic. I've seen reports of strategic stockpiling in Asia that suggest they are front-running the shortage. They aren't waiting for the price to drop. They're buying at market because they know supply is the only thing that matters. So here is my resolution. It's not exciting. It's not going to make you a millionaire by Tuesday.
I am simply removing myself from the blast radius of the paper market. I am taking possession. If I can't hold it, I don't own it. It's that simple. Because when that 28 million ounce buffer hits zero, the only thing that will have value is the thing you can actually deliver. So I have to ask you a question, and I want you to really sit with it, because the answer determines which side of the table you're on when the music stops. Do you want the receipt, or do you want the thing itself? Because for 40 years, the receipt was good enough. The receipt was liquid. The receipt was easy. But the era of the receipt is ending. The math says so. The vaults say so. The silence from the people who should be screaming the loudest says so. I'm going to keep digging into the industrial stockpiles next week. There's a situation developing with a major miner in Mexico, a legal change regarding export taxes, that might just be the match that lights this whole powder keg. Nobody is talking about it yet, but they will be. Until then, watch the lease rates, watch the EFP, and don't let the silence fool you. It's just the deep breath before the plunge.
You know, I kept hitting